and today I will be taking up Unit 7 of the subject Stock Markets Operation. Under this unit, we will be covering 3 sections. The first is Introduction to Future Options and Greeks. The second is Handling Grievances and Complaints. And the third is Introduction to Nifty Indices. Introduction to Future Options and Greeks. Future. In the stock market, futures are basically derivative contracts that obligate a buyer and a seller to trade the stock of a company at a predetermined price on a predetermined date in the future. Here, both the buyer and the seller are obligated to honor the end of contract. There are essentially 4 main elements to a future contract. The first, the obligation of the buyer and seller. The second, the trade of an underlying asset between the two parties. Third, the presence of a predetermined price. And fourth, the presence of a predetermined date for the date to occur. And as far as futures contract is concerned, the buyer of the contract is the person who is obligated to buy the asset, while the seller of the futures contract is the person who is obligated to sell the asset. Options. In the stock market, options are derivative contracts that give the buyer of the contract the right to buy or sell the stock of a company at a predetermined price on a predetermined date in the future. Here, the buyer has a choice to either buy or sell the asset, while the seller has no such right. If the buyer of the options contract chooses to exercise their right to buy or sell the asset, the seller of the contract will be obligated to act accordingly. And if the buyer of the contract chooses not to exercise their right, then the seller will again have to act accordingly. There are essentially 4 main elements to an option contract. The right of the buyer of the options contract, the trade of an underlying asset between the two parties, the presence of a predetermined price, the presence of predetermined date for the trade to occur. Unlike a futures contract, here, in an options contract, the buyer of the contract can be either the purchaser or the seller of an asset. In other words, the buyer of the contract can buy the right to either buy an asset or to sell an asset. If the contract buyer purchases the right to buy an asset from the contract seller then automatically becomes the seller of the asset. And if the contract buyer purchases the right to sell an asset to the contract seller then automatically becomes the buyer of their asset. Types of options. Call and put options. With options contract, there are 2 different types, call options and put options. This is quite unlike futures contract, where there is only one type. We can see the explanation below. Call options. A call option contract gives the buyer of the contract the right to purchase the underlying asset at a predetermined price on a predetermined date. In exchange for receiving this right, the buyer of the call option contract pays a certain amount of money as a premium to the seller of the call option contract. The seller of the call option is also called the writer of the option. Put option. A put option contract is the inverse of a call option contract. It gives the buyer of the contract the right to sell the underlying asset at a pre-agreed upon price on a predetermined day. And as with the call options, the buyer will have to pay a premium to seller for receiving this right. Option Greeks. Option Greeks are financial measures based on mathematical formulas to calculate the sensitivity of the price of options contract against factors such as the price of the underlying asset or market volatility. For example, if you have bought an options contract and want to know if you should exercise the right or not, you can use option Greeks to predict if the prices will rise or fall. 5 option Greeks collectively make the term are delta, gamma, vega, theta, and rho. An option trader uses these options Greeks to achieve the following objectives. Delta. Delta option Greeks measure the change in the option price for a unit change in the underlying asset's price. For example, if a delta of the call option contract is 0.5, it shows that each unit increase or decrease in the underlying asset, the option price will increase or decrease by 0.5 points. Gamma. The option Greek measures the change in delta concerning per unit change in the underlying asset. If the gamma value is 0.08, it shows that delta will change by 0.08 points if underlying asset changes by 1 point. So gamma shows what will be the next change in the delta concerning the change in the underlying asset. Vega. This option Greek measures the change in option prices per unit change in volatility. Vega is directly related to the option price, that is, higher the volatility or implied volatility, the higher the option price and vice versa. For example, a Vega value of 5 shows that option price will increase by 5 points for every unit increase in volatility. Thus, Vega shows the effect of volatility on the option price. Theta. Theta option Greek measures the rate at which the option loses its time value as the expiration date draws near. It is the rate of decline in the option price due to passage of time. If theta is -3 and everything else is constant, the option value of the particular day will erode by 3 points. Rho. Rho option Greeks measures the change in option price with the unit change in interest rate. If the rho of put option is -3, it signifies for each unit increase in interest rate, the put option price will decrease by 3. Importance of option Greeks. For investors who want to trade in options contracts, understanding option market Greeks is vital for successful trading transactions. It is because of the following benefits. Option Greeks help in mitigating the risk of losses as you can predict the nature of price sensitivity. They help in managing your investments as you can understand the effect of volatility on the options contract. Option Greeks help you take calculated risks and aim towards increased profitability. They ensure that your portfolio health stays positive with lower capital depreciation. Option Greeks help you understand the factors that can affect your investments and ensure that you invest cautiously and in good contracts. Now we have come to the second part of this unit, handling grievances and complaints. What are the types of complaints handled by SEBI? Complaints arising out of activities that are covered under SEBI Act 1992, Securities Contract Regulation Act 1956, Depositories Act 1996, and rules and regulations made thereunder and provisions that are covered under Sections 55A of Companies Act 1956 are handled by SEBI. Entities against which complaints are handled by SEBI are listed companies, stockbrokers, sub-brokers, stock exchanges, depository participants, registrars to an issue, share transfer agent, mutual funds, portfolio managers, bankers to an issue, collective investment schemes, credit rating agencies, custodians of securities, debenture trustees, merchant bankers, underwriters, alternative investment funds, KYC registration agencies. Which are the matters that are not considered as complaints by SEBI? Complaints that are incomplete or not specific, allegations without supporting documents, offering suggestions or seeking guidance or explanation, seeking explanation for non-trading of shares or illiquidity of shares, not satisfied with trading price of shares of the company, non-listing of shares of private offer, disputes arising of private agreement with companies or intermediaries. What type of complaints are not handled by SEBI? Complaints against unlisted, delisted, wound up, liquidated companies, complaints that are sub judice relating to cases which are under consideration by courts of law, quasi-judicial proceedings, etc., complaints falling under the purview of other regulatory bodies vis-a-vis RBI, IRDA, PFRDA, CCI, FMC, etc., or under the purview of other ministries which are MCA, etc. How investor complaints are handled in SEBI? SEBI has a dedicated department Office of Investor Assistance and Education, to receive investor grievances and to provide assistance to investors by way of education, and complaints are handled by all operational departments pertaining to their areas. Investors who are not satisfied with the response of their grievances received from stock exchanges or depositories can lodge their grievances with SEBI. Grievances pertaining to stockbrokers and depository participants are taken up with respective stock exchanges and depository for redressal and monitored by SEBI through periodic reports obtained from them. Grievances pertaining to other intermediaries are taken up with them directly for redressal and are continuously monitored by SEBI. Grievances against listed company are taken up with the respective listed company and are continuously monitored. The company is required to respond in prescribed format in the form of action taken report. Upon the receipt of ATR, the status of grievances is updated. With the response of the company is insufficient or inadequate, follow-up action is initiated. If the progress of redressal of investor grievances by an entity is not satisfactory, appropriate enforcement actions, adjudication, direction, prosecution, etc. are initiated against such entity. We have come to the last section of this unit, Introduction to Nifty Indices. Nifty 50 is one of the two national benchmark indices in India. The other benchmark is Sensex, which comprises the 30 highest performing stocks on the Bombay Stock Exchange. Nifty alone contains a large number of sub-indices. These are Nifty IT, Nifty Next 50 and Nifty Bank, each detailing separate asset classes, sectors or segments. Criteria for eligibility for Nifty listing. To keep up with the latest stocks and trends, Nifty is reconstituted every 6 months. During this time, it considers the 6-month performance of stocks and checks for whether a company's share fulfill the eligibility criteria. NSE Indices Limited has a team of professionals that currently manage the Nifty index. To be eligible for listing on Nifty, the following criteria are necessary. The company must be registered with the NSE while being a domicile of the country. The company's stocks should be highly liquid in nature. This is measured by the average of the impact cost. Impact cost is the price of trading a single security in relation to index weight as seen through the company's market capitalization. For a period of 6 months, the company's impact cost should be less than or equal to 0.5% or lower with 90% of the sightings and analysis made on a portfolio over 10 crores. The trading frequency of the company should be 100% in the past 6 months. The company should have free float average market capitalization. The market capitalization should be 1.5 times greater than the smallest company on the index. Any companies that have DVR shares, that is, shares with differential voting rights, are also eligible to be part of Nifty 50. Apart from 6-month reconstitution routine undertaken by Nifty, the index also goes through reconstitution when a company undergoes events like spin-offs, suspensions, compulsory delistings, or mergers and acquisitions. Additionally, Nifty also conducts a quarterly screening of each of its companies to keep track of whether they are adhering to the portfolio's regulations for ETFs and index funds. How is Nifty computed? Indices for Nifty 50 are computed through a float adjusted as well as market capitalization weighted method. The level of index showcases the aggregate of the market value of shares present in it for a certain duration. This base duration for Nifty is November 3rd, 1995. The index's base value is considered to be 1000 and its base capital is 2.06 trillion. The formula to calculate the index's value is as follows. Value of index is current market value divided by 1000 into base market capital. The formula is not the only means by which value is calculated. Changes in corporate procedures such as stock splits, rights insurance, and more are also taken into account. As Nifty is a benchmark against which all equity shares markets in India are considered, it regularly conducts index maintenance checks. This ensures it is stable and working effectively so that it can persist as a benchmark index of the country. So students, we have come to the end of this unit as well. Thank you for your patient listening.